Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Hi, everybody. I'm Jeff Barton. The Mortgage Voice with Jeff Barton, me, is available upon demand and on the air. Anytime you need to find the latest mortgage information, you can find us immediately on YouTube. We upload this show every week. Just search for The Mortgage Voice. You can also listen to the show on demand with your mobile devices via any of our podcast partners, Apple, Google, Spreaker, IO, Clips, Spotify, Stitcher, and more. Plus, we're available on traditional radio, of course, the medium of choice for me. You can go to all 5 stations in 3 different states, including Inland Empire in California, Las Vegas, Albuquerque, New Mexico, and up in Lake Tahoe. I'm Jeff Barton. Thanks for listening to the show. And again, welcome, welcome, welcome. This is our first show of 2022. It's a... okay. The mortgage industry is weird, right? So we go through these cycles which have nothing to do with the calendar year. We're in a cycle right now, and it may be ending. And one of the reasons I say that is because rates are rising. If anybody is aware of where the rates are rising to, give me a call, because we don't know. There have been prognostications from the Fed, from a number of Fed governors, from certainly a number of economists that talk about 3.5% to 4% interest rates by the end of this year. Now, where are we today? Let's talk about it. 3.35 is the 30-year fixed. So if you go to the average of the 30-year fixed today, and you add, let's go to 4%, it's really only going to rise another, not a little over a half a point for the rest of the year. So are those bad rates? No, they're not. But what that does, couple that with the rising home prices, it prices out millions of people from buying a home. And that is the issue, what we're dealing with. However, if that happens and prices fall, that'll be a good thing, because more people will be able to then afford the house because prices will come down. All of this being what it is, it's a complex situation when we're talking about mortgage interest rates, because they're tied to many, many things. We've been drunk on free money from the Fed. When was the last time this happened? 2008. Remember? We used to have, So we invaded Iraq in 2001. 2001? And since that time, money was made available and cheap by Alan Greenspan at the Fed. It was to take the focus off of what was happening in the world. And one of the reasons, we had 9/11, we had certainly the dot-com bubble burst. A lot of things went on right then which would have killed a normal economy, but money was made cheap. So that's very similar to what's happening now. I'm not saying the outcome is going to be the same, but there are a lot of parallels to the cheap money, the driving real estate market, the lower interest rates. And, obviously we all know what happened. There's a difference between then and now in terms of what the product is. The product today is a lot better than it was then. But is the debt any different? Worldwide debt in 2008. Daryl, do you know what the worldwide debt was in 2008? Just take a wild guess.
As a percentage, or as
as an actual number.
You mean in the trillions?
Yes, it was.
Let's say 8.
$288 trillion was the total world debt in 2008. Guess what it is today?
Double that.
No, it's $300 trillion. But the parallels between...
So 1.5 times.
Yes, exactly. I think what's happening today, what happened then, the amount of debt that is out there in the marketplace. Now, what is that debt driven by? And I talk about this because it's really going to affect the psychology of the economies of the world if that debt comes a-calling. Now, what do I mean by that? The only reason you have debt is because you have something to borrow against, okay? Let's go to flash forward today, China, Evergrande. What's happening to that company? They owe some $300 billion in debt. They rang up a bunch of debt over the last 10 years to build housing in China. the largest real estate boom in history. You can't imagine the amount of, in China they have 100 cities over 1 million people. How many in the United States are like that? Maybe 15 to 20. And some of their major cities have 20 million people in it. I think more than one. So this boom in China that has happened, which has driven real estate and the real estate developers to borrow money, because the burgeoning middle class, which was built for the last 40 years, has caused the demand. So this is a long-term plan by the Chinese in order to make their own economy sustain their buying and selling. In the U.S., we do that already, and we've been doing it for generations, i.e., the way that people are paid, how much they're paid, really drives demand. Demand drives growth, and growth in the U.S. means a higher standard of living. That's really what we measure it by. How much stuff I can shove in the garage measures our standard of living. In China, it's not so different. It's just they're doing it with housing. So Evergrande is $300 billion in debt. Their entire sector is 25% of the economy. So if debt is driven by, in China's case, growth, and that growth stops, what happens to the risk of that debt? Why does that translate? Because in the U.S., it's a similar issue. There's a guy, and his name is Hyman Minsky. Nobody's ever heard of Hyman Minsky unless you're in the biz. So Minsky, here's what he says. He says, this guy says, prolonged periods of financial market stability, which is what we've had since 2008, tends to set up the conditions for pronounced financial market instability. Because when you have long-term stability, assets tend to rise. The amount that you think my house is worth today is more than you thought it was worth in 2010, because we've had this long period of stability. Assets rise, therefore the amount of money borrowed against those assets, well, obviously that rises too. But when conditions change and the valuation and the actual cost you're going to pay for those assets drops, what happens to the world economy? Now, the reason this is of a concern to me is because it is happening hugely in China. And China, forget what people tell you, is the largest economy in the world. They are largest economy because of the potential that they have to grow where they are now to where they're going to go. In the U.S., how much are we going to grow, really? Even if it's 2-3% a year. China has the potential, because of the population in China and because of the undervalued and underused resources, to double the U.S. economy in a very short order. However, if it's done in a way by which they are borrowing against current assets and the assets drop, the debt load will crush them, and that's the concern I have. If that happens, and this is the perverse nature of the way I'm thinking about it, everybody will fly to the U.S. dollar and treasuries. It will sink the treasury to the lowest yield possible, and thus driving mortgage interest rates back down. This could all happen this year, too. There are many predictions about where interest rates are. I mentioned the 30-year at 3.35 now, and where they're supposed to go by the end of the year. But there are so many unknowns out there, and the unknowns are really spread across the world. Guess how much worldwide? Wait a second here. Let me make sure I got this number right. It is insane. Okay. Worldwide debt. Give me a number. The world debt I gave you at 300 trillion, right?
Right.
Okay. It was 288 in '08. China's debt currently, what's owed in cash value today, that needs to be liquid in January, is $700 billion, almost $1 trillion, which means that the liquidity required to maintain U.S. banks has always maintained a certain, it's like the old gold standard. It was on a standard, you had to have that much money in. China is dropping that to continue their growth patterns, in order to be able to fund growth, in order to be able to fuel demand, which is dropping heavily. There's a lot going on in the world economy. It's going to affect you in a lot of different ways. Let's get to it. I know, Cuomo's gone, right? I can say that. Let's get after it. Anyway, I'm Jeff Barton, your voice in the mortgage industry. We'll be right back. Our show here, The Mortgage Voice, is available whenever you need information, even if you need it right away. To fit your busy schedule, of course, we make it easy to watch or listen to the show. Find our episodes on demand from our website at themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice, and our Mortgage Minutes and weekly program also available on YouTube. Podcast form, wherever you need it. Our podcasts, including Apple and Google Podcasts, Stitcher, Spreaker, Podclips.io, Spotify, and more. I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Welcome back, everybody. I'm Jeff Barton. This is The Mortgage Voice. Hey, check out our website at themortgagevoice.com. There you can find our latest on-demand episodes of The Mortgage Voice and information about our guests as well. This next guest is awesome, and he's on there too. Contact information for those guests. You can also read my blog, which will keep you updated with the very latest mortgage news. Check it out. Bookmark us. That's themortgagevoice.com. I'm Jeff Barton, and again, this is The Mortgage Voice. Thanks very much for tuning in. We're on a bunch of radio stations, as I said, and we're on a bunch of podcasts. But the favorite thing I do in this show is to interview great and smart people who know way more than I do. I try to delve into all the economic issues out there, but specifically in different industries, we have to go to the experts, and that guy right now is Oscar Carboni, been on the show before. We're trying to do a real estate pilot show with him as well. Anyway, Oscar, how are you?
Very well, Jeff. Thank you for having me.
Fine. Thank you very much. Oscar has a stock buying school. He is a trader, 24-hour. Oscar, shout out the place where people can watch you and what you do.
So I literally run a 24-hour trading desk. I used to be a trader on the exchange who stood in the pit and screamed and yelled like the days of old. And they sent us home in 2006 with computers and told us, no more gathering together. So I've created my own trading pit, and I spend my life there, and I invite everyone who wants to trade to join me, and that's at livewithoscar.com.
Livewithoscar.com. Excellent. Thank you very much. Okay, let's delve into it. Economy, what's happening? Another record day, I guess, here. But there's something going on which I'm not really quite sure of. What's driving the market, and what are some of the economic forces that may not be on the surface?
So, of course, we've been in a tremendous bull market, which, of course, has been aided by the Fed and all the money that they've pumped in.
Yep.
And that's kept this market running for quite some time. And, of course, now we've got inflation due to adding too much money into the system.
Right.
So when that starts to happen, the Fed, or the FOMC, the Federal Open Market Committee, decides to pull triggers, either to raise or lower rates, mop up some liquidity. What's going to happen this year is the Fed is looking to mop up liquidity. In other words, they're going to stop buying bonds, and at some point they're going to raise interest rates. And I think the big question for everyone out there listening is what happens after the Fed raises rates? Should I buy a house now? Will the stock market crash? I think those are the important things to people.
No,
how about you, Jeff?
You know what? I agree with that 100%. I think I spent a lot of time talking about what's happening in the overall economy and why things are happening the way they do. In the U.S., a little bit different than what they're doing around the world, just simply because our inflation is intolerable, especially during an election year. There are also some other forces driving money to the U.S. if, in fact, we get an Evergrande implosion in China or we get a war in Europe. Explain some of those factors when we're trying to figure out, what is happening to the 10-year.
Okay, so what's happening with the 10-year and the 30-year is they are starting to drop in the futures price, which means the yield is starting to go up, and so is the interest rate. Why would that bring money into the United States? Because we've got the highest interest rate in the world right now, and if we raise it higher, other countries take their money and immediately sell their money and buy U.S. dollars so they could enjoy the higher interest rate, because you can't buy U.S. bonds or stocks unless you buy U.S. dollars. So that would drive money into the U.S. Now, you mentioned something a moment ago that was interesting. You talked about that the inflation has been tolerable, I think were your word.
Right.
And you're exactly right, because we are in the United States. If you're watching the U.S. dollar, it's been moving up as rapidly as inflation, meaning we don't really feel it.
Right.
As an American, you go out to the store, everyone just did their holiday shopping, and I'll bet you they didn't feel like they were squeezed so badly that they've got no money left. Because our dollar, we've been blessed, it goes up with inflation right now.
Right.
So if you are in any other country, you are not being blessed. You are absolutely feeling inflation and the wrath of the dollar moving higher. But if you are using U.S. dollars and you're a U.S. citizen, enjoy the ride. Right now, it's not bad for us.
Right. I think a lot of what we hear on television is meant to keep you either watching television or get you scared into doing something you probably shouldn't be doing. What would you say with, I guess, somebody who is wanting to buy a house this year and they need to take money out of the stock market for a down payment? Do you think it's a wise move, a smart move? Do you think it's better to go to a different type of loan? Absolutely. Okay.
Okay. Absolutely. Here's why. So it's a great question. And I've been doing this for 40-plus years in the depths of Wall Street, where you really do learn what's going to happen if a trigger is pulled. No one ever knows what's going to happen in the future, but you do learn what happens if they pull triggers.
Right.
So the Fed is going to raise rates, and here's how this works. When the Fed first begins to raise interest rates, it makes the stock market adjust lower, while at the same time it gooses higher the price of real estate. And why that would be is real estate, if what they call when they first start to raise rates, this is called the get off the couch segment of raising interest rates.
Right.
Now, anyone, maybe like yourself, that's been thinking about buying a house and knows interest rates are 2%, if they think the Fed's going to raise rates, they decide finally it's time to go buy that house. Same thing with businesses. If they're looking at a property, a commercial property, and they realize interest rates might move, it's better for the shareholders to buy the property before the rate goes higher, or as soon as the rate starts to go higher. So that will actually help real estate. For the first 3, 4, 5 raises over the next 2 years will boost real estate. It's a great thing to buy right now.
Now,
it'll make the stock market adjust opposite of the real estate, because most companies that are listed on the stock market issue monthly bonds, quarterly bonds, whereas they borrow money from you and they promise to pay you back X amount of interest. That interest is always more than the Fed would pay you on bonds, which is why you would bother to buy corporate bonds. Now, if the Fed raises rates, the corporations have to raise their rates that they'll give you to borrow your money monthly, which means it costs them more money and it makes their stock worth a little bit less. And that's the exact relationship that will take place.
Okay, that's excellent in terms of figuring out exactly what's going to happen in the stock market. Real estate itself has always been a way by which you can protect yourself from too high of an inflation. Do you think we're going to see, because in your scenario here, it looks like real estate prices are going to go up, and I think earlier in the show I was saying that we already have a 77% unaffordability index in this current market compared to 39% last year. Where do you think prices can head? I mean, 20% a year is really unsustainable.
You know, what will probably happen is this, and I mentioned about a year and a half ago, I made this a projection.
Right.
I would say if in the next 10 years, if you do not own some kind of a house, there'll be $1 million minimum. You'll never be able to afford one if you don't get yourself in the next 10 years.
So you don't see a real estate bottom or crash or some kind of downside? Usually comes every 10 years as well.
You know what? We may have an adjustment at some point, but money is still so cheap, the cheapest interest rates we've ever had.
Right.
If they raised rates 4 times, it would go from 2% to 3%.
Right.
You know what I mean?
Yeah.
Nothing.
No,
if
you're
they
right.
raised it 8 times, we'd be at 4%. It's nothing.
Right. No, it's true.
In other words, it'll just continue to fuel real estate. Now, here's where one of our problems lies. The price of copper is through the roof.
Yep.
The price of lumber is through the roof.
Yep.
And getting supplies and workers to build those new houses it's not as easy as it was 2 years ago. more of a reason to expect real estate to go higher. They can't build them quick enough. If they can, they've got to charge more for them because of the price of lumber and copper and all other raw materials.
I agree with all that. I wish we had more time. We're up against it. Could you shout out one more time a way by which people can follow you, watch you, learn from you? Ladies and gentlemen, goodbye, Oscar. Thank you very much, Oscar, for coming on the show. I guess you just hit the wrong button. Regardless, Oscar Carboni is a terrific guest on the show. Been in the business a long time. You can look him up. He's had a lot of guest spots on Fox News and a bunch of other national news shows, as well as his own particular way by which he does his business. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back. Our show here, The Mortgage Voice, is available whenever you need information, even if you need it right away. To fit your busy schedule, of course, we make it easy to watch or listen to the show. Find our episodes on demand from our website at themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice, and our Mortgage Minutes and weekly program also available on YouTube. Podcast form, wherever you need it. Our podcasts, including Apple and Google Podcasts, Stitcher, Spreaker, Podclips.io, Spotify, and more. I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Welcome back, everybody. I'm Jeff Barton. Hey, check out our website at themortgagevoice.com. There you can find our latest on-demand episodes on The Mortgage Voice, information about our guests as well as their contact information. I know you probably heard the show many times, want to know how to get in touch with them. Go to themortgagevoice.com. Their profiles are there as well as contact information. You can also read my blog, keeps up with me, updated the very latest mortgage news. Check it out. Bookmark us. That's themortgagevoice.com. Okay, I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in. Thanks for coming to us. We're providing you with a lot of information today. Let's get specific. Loans, what kind of programs, what's available out there, rising interest rates, a little bit, but still plenty of money out there to lend to you. With us is Wendy Van Wessel from Kind Lending. She joins us again. Wendy, how are you?
I'm just fine. Thank you very much, Jeff. How about yourself?
No, I'm not too bad. Thank you very much. A little stressed, the loan business. Never a dull moment.
Yep.
Tell us about what's going on over at Kind. Give us some examples of great programs that you're offering and how people might qualify.
I really, really am looking forward to 2022. I think that there's a lot of changes that are going to be going on with the lack of buying, the loans, the 10-year bond, the stock market. The rates might inch a little higher, get a little higher there, so maybe refis a little dried up. We're worried about it. Purchases, there's not a whole lot of stock. So we have some other options for the borrowers out there that didn't qualify before that might qualify now. Different ways to qualify. CPA does your taxes one way, and all of a sudden you don't qualify for a loan. So these are called non-QM programs, and they offer you just your W-2 or just a P&L signed by a CPA, a CTEC, or an EA, or just a 1099 form, and that's also called the real estate officer's loan because they tend to write off a lot. So those are offered to you. There's other things for non-owner occupied property, but there's different things out there now that you can help you qualify for the loan.
Okay. Tell me, give me an example of one of these loans, whether that real estate agent loan or something that you need to do to bring to you in order to get qualified for a loan like that.
If you were a doctor, an attorney, someone that gets paid 1099 and then you write off a lot of stuff because you don't want to pay a lot in taxes, it's called a 1099 only. You're going to give us your 1099s to show us what kind of income you use, and they have like a set 10% that you take off of that for expenses.
Okay.
But often expenses are more than 10%. So now all of a sudden your debt to income ratio with the more money that you're showing for income allows you to get a loan, and you can go to a 50% DTI.
Okay, that's excellent. Now, I know what you mean about writing things off, but one thing I want to be clear on, 1099 usually means that, you get a 1099, but it's not monthly, it's yearly. So what happens if you're in the middle of the year and you need to add up the income that you've made all year? How do you do that?
Well, if you're self-employed in 1099, they want to know that you're going to be continuing to make money. So if you're a real estate person that has properties that you flip and sell, Do you have some real estate properties still in your name, in the LLCs that they usually put them in the individual property names? Do you have some there available to sell in the future? If you're an attorney, do you have a history of making money with certain clients? If you're, what else are they, doctors? Do they go to certain places and have a continual kind of thing? That's COVID. COVID came into play because, everybody had different work environments and changing the hours and pay. So you have to prove that you can continue to make it, but maybe with a bank statement, maybe with clients that you have and letters saying that they're going to continue to use you.
So basically what you're saying is, that I hear you saying is, Kind can manually underwrite these files and work out the income based on several different factors, whether 1099 is one, but in June you're only going to have the bank statements or deposits you've been making for the last 6 months, so that they average those out on a monthly, and that's your monthly income after your 1099?
We do just bank statements, too. If you have 12 months worth of bank statements or 24 months worth of bank statements, you can go off of just those. You also have the debt servicing for if you have a non-owner-occupied property, and your rental income will cover your principal and interest and taxes and insurance payment. Then you don't have to prove any other kind of income. So that's a DSCR loan. So those are options for the people out there to continue to get loans that didn't qualify maybe before.
Okay, availability of money. There seems to still be a lot of money to be able to be lent, but because housing prices are high and refi rates are obviously going up, you're expecting less big business? Is that what you were saying earlier?
The refi, everybody's worried that people refinancing, although they have a lot of equity in their properties right now.
Right.
The rates are going to go up maybe 1%, 1.5%. What do you think it'll go up by? Because they're going to stop buying as many loans as they did before, Fannie and Freddie, right?
Well, I think that the interest rates, if people are, who are in the know, whether it be an economist, whether it's Lawrence Yun, who's the chief economist over at the National Association of Realtors, whether it's a couple of these Fed board chairs, they're all thinking, 3.5% to 4% is the height by which we're going to see interest rates on mortgages rise. The 10-year is obviously going to go up, but, who knows? I don't know.
Right, so they're not going to disappear, but there's a lot of people that were out there that wanted to do some things that could not. And now they still, with the rates, they're still, do you remember when they were 15% those rates at one time? No
question about it, but, everyone lives in the moment, so they're looking at rates rising 0.25%, and really, from 3.75 to 4% or 3.5 to 3.75 is absolutely nothing. But because the house prices have really risen so much, so fast, the affordability index is really low. So people are squeezing, even though they're probably making a couple $100,000 a year, into something that they can afford, which, in this market could be $400,000, $500,000, $600,000 easy.
Right, and we also have the higher back-end debt ratio. We have we have the jumbo loans, we have the Symmetry Seconds, which is a HELOC, which is like a 0% interest, a credit card, 0% credit card you can take out and put back in at interest-only payments for the first 10 years. If you want to do a HELOC, you could utilize that. But look at what our loan limits went to. For conventional conforming in LA, it's $625,000.
Yep.
For high balance, it's $978,800. You add a $500,000 HELOC on the back of that, and you got $1.1 and $1.4 million loans. You can still get a lot of house for that, I think.
Well, I agree. I agree 100%. We were talking earlier in the show about the debt and the world debt and how much the debt in the world is, weighing on lenders who lend out the money. Obviously, there's a lot of lending going on both here in the U.S. and certainly around the world, China, Europe, third world countries, emerging markets. All of this debt, if we see any kind of downturn, either long-term because of COVID and the economies never pick up, or if some other disaster, let's say a war in Europe, is really going to affect the ability of lenders to lend money because the risk is going to be higher, then what happens to all that debt? And where do foreign investors go when there's uncertainty? They rush to the 10-year and the 30-year, which would drop mortgage rates again.
Yep, that is hopefully no wars.
No,
no catastrophic events, but you are 100% correct with that's where they go to put their money to be safe.
Right, and when that changes, then we're going to have a different world. But right now, even though people can argue what economy is the biggest or the potential for growth. And I just think, if people are still coming to one place that's a safe harbor or, home base for them, it's still the U.S. And it's the U.S. currency, the markets, the equity markets, and certainly the 10-year and the 30-year.
Yes, I don't think Bitcoin is that safe yet.
No, I mean, I'm old, so I don't like it. But anybody under 30 years old loves Bitcoin or all the cryptocurrencies. They just do. They just think, this is my Vegas.
And FYI, we can take cashed out Bitcoin for down payments.
Nice. I like that, too. Wendy, could you shout out to people how to get in touch with you at Kind? We got about a minute left.
Sure. The Wendy Van Wessel, Kind Lending, Glenn Stern's newer company. He took his best ops people. My number, 818-292-2572.
Excellent. Wendy, that's excellent. And you work in Southern California mainly, yes?
I do. You are correct. And Nevada shortly.
Oh, excellent. Oh, Nevada, too. Well, that's great. Thank you very much, Wendy. I appreciate you coming on the show, as always.
You have a great day. Thank you very much.
You, too. That's Wendy Van Wessel from Kind Lending. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back to the show. I'm Jeff Barton. This is The Mortgage Voice. Our show is available anytime you need information, even if you need it right away, to fit your busy schedule. We make it easy to watch or listen to the show. Find our episodes on demand from our website at themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice, and our Mortgage Minute and weekly program always available at YouTube. Go to YouTube. YouTube's great, by the way. Podcast form wherever you get your podcasts, including Apple, Google, Stitcher, Spreaker, Podclips.io, Spotify, and more. We're on a number of just many places that you can pick up the show. But always when you go and pick up the show, click that you like it, join as a member. Why? Because you get instant alerts as to what's happening in the marketplace, especially from our perspective. And what do? Real estate and mortgage, and we've been doing it for almost 10 years on the radio. I'm Jeff Barton, and thanks very much for tuning in. We go to the experts when we want to know specific details, especially about markets. We're talking Southern California today, and certainly in that vein, in the real estate area, Meredith Schlosser, who's been on the show before. I believe it's Keller Williams. Is that right, Meredith?
No, thank you again for having me, and Happy New Year. No, I'm with Berkshire Hathaway right
I'm
now.
so sorry. Why did I?
It's okay.
I like Berkshire better anyway, so thank you very much, and thanks for coming on the show.
Thank you so much for having me. Happy New Year.
Happy New Year. Okay, let's get right to it. The market, can it sustain? Where is it heading? And affordability, do you have enough clients to fill the need? I guess you might, but...
Yeah, good question. The question I'm answering every day, multiple times a day. I think right now, with inventory being once again at an all-time low, people willing to bid over everybody, give away their firstborn to get a house.
Yep.
It's unlike anything we've seen, right, in a very, very long time. And people getting extra creative. So as far as the need goes, any listing that we get is getting snapped up, before I can even put it on the MLS sometimes, really, essentially.
Wow, that's, we always say this, and I've said this for many years about inventory. Inventory will grow and it will shrink, but it's about your ability. Can you afford whatever's available right now? And if you can, is this the best time to buy? My answer today is absolutely. What's your answer?
Absolutely. If you can afford it with the rates being where they are and you have confidence that whatever you're buying will, of course, increase in value over the future, which as we all know real estate does, then why not, right? I mean, it's just about getting, as you know, an agent who can fight for you and be aggressive in making the shining star to win the offer. That's the biggest challenge, I think, for buyers right now is getting an agent that can get to the property.
Okay, interesting. So in Oregon, they have eliminated the love letter, right? They've made it law that you cannot, as an agent or a prospective buyer, write a letter that says how great you are, right? This is my family. These are my kids. I've loved this house since I was, 1 year old. You can't write those anymore. How do you put your clients, especially if you're representing buyers, and that's another question, buyers or sellers, but if you represent buyers, how do you give them the advantage over somebody else without an ability to at least make them see you more than just numbers on a page?
I think it's terms. I think it's being proactive, having the mortgage broker not just write some basic pre-approval, actually just get them underwritten before they even make an offer. So they can go aggressive, waive contingencies, be aggressive on inspections, educate them on what inspections they need to do prior to. We book all of our inspectors when we make an offer on a property. I have inspectors already on hold because people are getting so booked out now, the good ones, as you and I both know. When I write an offer, no matter what it is, if I'm going to get that deal or not, my inspectors are already on hold. They're on hold for Monday, Tuesday, Wednesday, whatever it may be. If I get the deal, great, I'm already lined up. The listing agent knows that. The mortgage broker's calling them saying, hey, I didn't just run credit. I've actually underwritten this file, and I know they can get pre-approved. So I can then waive contingencies, close quicker. We're already 5 steps ahead of other agents. So that's what I'm going to the listing agent with, not doing that BS love letter anymore, because we all know that's just, it is what it is. It's great, it's cute, whatever, but that's not going to win the buyer the deal. The listing agent, the seller wants to know who is going to give me the least amount of headache, who's going to close on time or early, right? That's what a listing agent, and I, obviously, as you know, I represent both buyers and sellers. That's what I want to know when I'm the listing agent. Who's going to get this deal closed?
You know, when we talk about that kind of stress, I'm involved in a number of transactions during the year, and that stress never gets easy, meaning that if, in fact, that doesn't happen, it doesn't close on time, or there's an extension needed, explaining to both buyer and seller what the progress is. How do you deal with it as a real estate agent who has to quarterback the whole thing?
Well, I just let when I'm representing the buyer, I tell the listing agent, hey, I have ABC inspectors lined up. Look them up. Look up their reputation. You can look at my reputation. I'm closing deals. I'm not a newbie, number one. Number two, talked about the mortgage, right, knowing that that's already been handled. And then I say to the listing agent, hey, you know what? If I don't close on X, I'll pay you per diem. I'll pay you X. I'll give your seller a free lease back. It's about what that seller wants and what's important to them. Free lease back, per diem if we close late. What's going to make me vulnerable and my clients vulnerable if we don't close the deal on time? And then why would they not choose us? Who's offering that, right?
Right.
We're offering to, we're not to be desperate, but we're trying to make ourselves look appealing, right? Because if they have a deal, as we're offering right now, where there's 18 other offers on the property, it's under $1 million, it's in the valley.
Yeah.
Why would they choose me? My clients aren't cash.
Right.
So I can close faster, just as fast as the cash. So why are they going to choose me over that cash buyer?
Well, the only reason you would go, you're a seller, right? You're looking for the highest price, really, unless there's some other issue that you got to close quickly. In that, with your buyers, I mean, you can do terms and you can do conditions and everything else, eliminate all kinds of contingencies. But at the end of the day, the seller wants the most money for their property. And when you run up against a situation, either as a seller's agent with that many offers, isn't that what you're looking for, or what else can you add to the deal?
Of course, right. And getting people, another thing, Jeff, that I'm doing that sellers love, is as soon as contingencies are removed, I'm getting the 3% initial deposit released to the seller.
Oh, yeah, they love that.
So they love that. Then they're like, all right, cool, I got you, let's go, And that's something where if that buyer is going to close and they really want that property, they're not going to be, finicky. They're going to get that deposit released.
Thanks very much. That's Meredith Schlosser from the Meredith Schlosser team at Berkshire Hathaway. I'm Jeff Barton, your voice in the mortgage industry, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back. Our show is available whenever you need information. If you need it right away to fit your busy schedule, we make it easy to watch or listen to the show. Find our episodes on demand. We are Jeff Barton, The Mortgage Voice, from our website at themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice. on our Mortgage Minute weekly programs, always available on YouTube in podcast form, wherever you get your podcasts. That's podclips.io for us. We go there all the time, including Apple, Google, Stitcher, Spreaker, podclips.io, as I say, Spotify, and more. I'm Jeff Barton. This is The Mortgage Voice, and thanks very much for tuning into the show. We were talking earlier segment about what's happening in China, how it affects us here, why debt worldwide might affect us if assets fall, and they may fall. And what happens to the bank? Would you lend money to somebody who owes trillions of dollars? Probably not, right? So that's what happens when credit freezes. There is an upside to that, as I said earlier, where we might see the interest rates because people are flocking to the Treasury in the 10-year. However, what is the 10-year doing? I'll tell you what it's doing today. The 10-year yield, 1.657. That's up probably 20 basis points over the last week. That's a big jump, by the way. We are now pressing on the outside of the upper end of what that range has been from roughly about 1.33 up to 1.7. We're almost at 1.7 now. We're probably going to break through that. The reason is that inflation and what's happening to the economy, the Fed is obviously ending taper, or not ending, but continuing taper till their stimulus program, QE4 or whatever the heck it is ending probably in March, which means that a couple of the board governors, this one guy, the Fed board guy, Kaskari, I think, is he in Denver or Dallas, one of those two. He sees 2 interest rate hikes. We've heard as many as 3, what they call the dot plot, when they figure out based on what the minutes are from the Fed open market committee meeting, they kind of figure out where interest rates are going. They think three times this year, and this rate is obviously the Fed borrowing rate that they lend out to their member banks. But that's going to, if that raises a couple times, taper ends. They're really trying to get a hold of inflation. They don't want that to go any higher than it is. It's been the highest it's ever been. Well, not ever been, but in the last 40 years, and that's a lot. Most people who are in the economy right now never saw inflation this high. I, of course, being older, I remember inflation at 18 to 21% a year, and that was back during Nixon's last couple of years and Carter's whole administration. Let's see. Okay, let's get to a couple of things with news to use section. The 30-year, as I said, is 3.35%. The 15 is at 2.70. The FHA is at 2.98. We're almost at 3% for FHA. That's a pretty much a big benchmark. 3.24 for the jumbo, and that's also come up 10 to 15 basis points. 3.75 for the 5/1 ARM. The 10 years, I said, is at 1.657. The rates are the highest they've been in 9 months. When we got into COVID, we were talking about rates rising. We were talking about rates rising simply because, the demand was going to be higher, and therefore we were going to see rates rise. We were going to see the 10-year rise because they had to attract borrowers, attract investors. Well, that's kind of the way it is right now. It's a good thing. It's a way to slow down the economy. It's a way to cure some of the inflation worries that we have. Let's see, 4.5 million. This is a problem, by the way. 4.5 million people quit in November, quit their jobs. That's roughly 3% of the workforce. We've had an issue with quit rate probably for the last year, maybe year and a half. People just say, hey, I'm done. I can't do it anymore. There's a lot of stress in the marketplace. And stress always comes when outside forces affect daily routines. What have we got? Omicron, and that is crushing people. I have 2 children that have Omicron, so I know exactly what everybody else is feeling out there in the marketplace. Now, as an older person, I don't go out that much anyway. I come to the studio, I go to the office, and I go home and eat. And that's about it. My wife and I live pretty much a sheltered life. Although we have been out some, but Omicron will just take over for a while, and it really causes stress in the workplace, and therefore people are saying, I'm done, I can't do it anymore, especially people my age. I'm 66. There are people anywhere from 55 who I talked to somebody the other day said that they were going to retire, a dean of some school over at Pepperdine, talking about just, hey, that's it, I'm done, I don't want to do it anymore. And you're wondering, well, you know what, Omicron is really affecting people's psyche, and therefore it are decisions being made that are best for both those people. But stress is real, so if it's out there, I understand it. Evergrande ordered to demolish 39 partially built units, and they're $300 million in debt owed. And we talked about that a little bit earlier. The pending home sales down 2.5% from this time in 2021. Pending home sales is an indication of what's going on in the marketplace, but I think it's really a greater indication of the affordability, what's going on in the marketplace. Home affordability is down 77% from this time in 2021. 39% affordability index in 20. So we see that the affordability index at 77%, meaning that 77% of the people who want to buy can't because they can't afford it. A year ago, it was only 39%. So that number's really jumped. And it's jumped because the value of your home, depending on where you live, could have jumped 20%. I mean, I was on a call with a few people in Nevada. Las Vegas principally drives that real estate in the entire state, although there are pockets, whether it's Reno or the state capital or wherever it is. They're from some of those other places. But Vegas properties have gone up on average $100,000 this year. That's unbelievable. You talk about median home price in Las Vegas of upwards to $400,000. During the recession, I could have bought a condo in Vegas for $25,000. My wife talked me out of it because she says it was too expensive. Think about that for a second. That was in 2010. That was only 12 years ago. We're now looking at those same condos going for $100,000 and $150,000. So within 10 years, it rises 4 times. It's really remarkable. It's kind of an incredible thing. When we're talking, okay, so the bond buying program viewed the ending in the program in March and the inflation are back under control. Okay, the Fed will be forced to raise interest rates at a very much faster pace than the market is now expecting. This would seem to especially be the case considering the negative interest rates currently are an inflation-adjusted time. Okay, so what does that mean? If we're about ready to start raising rates, and the reason why we raise rates is because inflation running at 6.9%, if you have rates at 2.3% or 2.5% or whatever they are, you're losing money. Every year you're losing 3-4%. So that's another reason why when you're looking at interest rates, both, whether it's on your credit card, your car loan, your any other adjustable rate type of mortgage you may have, certainly your prices at the store, prices for anything. I don't know if anybody has heard about this company. There's a company out there in the used car business. They are now... I guess they've got 21 offices. They're opening more offices in different cities around the country and in Canada. What they're doing, because the used car market is appreciating so much, they've created a business where they're buying used cars in bulk and turning around and selling them like they're new cars, what they call the pre-owned car, right? It's like a brand new car. You're paying, I think the average cost of a new car, not a new car, used car, was $29,000. That's, just unheard of. I get calls on my 2008 Toyota Highlander wanting to pay me really close to half of what I paid for it. I paid $41,000. I had a $20,000 offer the other day from a dealer. It's really incredible. That's inflation, folks. And unless the interest rates that are either being charged by your bank or in the 10-year yield or treasuries begins to match what inflation is, the government's losing money every year. And you can't continue to lend out money and when you get repaid, lose money to be in business. So that's another reason why you're going to see interest rates and rates overall rise. Again, there's a lot of caveats to that, but that's kind of what's happening. Let's see, what else we got in the business? Oh, yeah, I said that. $700 billion cash demand early in the lunar year for China. That's a big deal, especially if the real estate sector can't bounce back. Listen, I'm Jeff Barton, your voice in the mortgage industry. Really appreciate you listening and coming to the show each and every week. We try to cram a lot in there, and I certainly have enough opinions to match what's in terms of information. But the information's real. I'm Jeff Barton, your voice in the mortgage industry. We'll see you next time. Our show here, The Mortgage Voice, is available whenever you need information, even if you need it right away. To fit your busy schedule, of course, we make it easy to watch or listen to the show. Find our episodes on demand from our website at themortgagevoice.com. We're also on SoundCloud at The Mortgage Voice, and our Mortgage Minutes and weekly program also available on YouTube. Podcast form, wherever you need it. Our podcasts, including Apple and Google Podcasts, Stitcher, Spreaker, Podclips.io, Spotify, and more. I'm Jeff Barton. This is The Mortgage Voice. Thanks for tuning in.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.